Kyle, it's very good to see you. As we know, we've been talking about like a market outlook for 2022. We knew 2022 was going to be a turnaround year following the stimulus and economic rally of 2020 and 2021. And the purpose of doing any kind of outlook is not to predict, but to prepare. And Brookstone CIO Mark DiOrio has already said that we should expect volatility and a correction, possibly even an echo bear market, which is a correction of 20% or more. What are your thoughts on where we are right now?
Yeah, definitely. And hello, Erin. I think that we got three big things. It's definitely a turnaround year. If you look at the last 3 years, they've all been pretty historic. A matter of fact, in recent history, they're the eighth best 3-year run we've had.
Wow.
But the three big things that are on the horizon, and I think everyone's starting to see this, is we've got a volatile equity market. We've got rising interest rates. I mean, the 10-year yield almost hit 2% this morning. That's quite a jump from last year. And three is big inflation. So to us, really appropriate portfolio design is kind of the key to surviving, this year. And a lot of times that involves some diversification.
And so that's what we're looking at here right now, because that leads us into the next question, Kyle, which is the market's being volatile already. Monetary policy is a key driver of asset prices, so inflation doesn't run away. The 60-40 portfolio bonds used to be a big part of that, but you said that we should be considering other risk reducing assets right now.
Yes, and I've been really hammering on the fact that we really need to take a close look at bonds in our portfolios, because as interest rates do rise, the longer term bond holdings tend to suffer pretty poorly, especially in quick rises. So we're looking at some unique solutions to that conundrum, which are going to be things like buffered ETFs, hedged equities, and even some structured notes as part of a portfolio design.
That's always a good consideration right now. Now, let's take this. I love what we're talking about right now, which is behavioral finance. I know you are a student of behavioral finance. And basically, we know already that during market downturns, people tend to panic and sell. Explain where you think we are right now on this chart.
Yeah, for sure. So I think over the last 3 years, we got very confident, very thrilled, and some of us very euphoric,
Right.
if we hit some big returns. But this January, I think, has kind of spiraled people between nervous and worried here. And usually if you let your emotions drive, it tends to force you to buy high and sell low, which is going to
Right.
kill your returns over the long term.
Mhm.
And most of the time people let their emotions drive when they're not invested appropriately, right? If you're kind of playing outside of where you're comfortable, you're really more aggressive than you probably should be. That's probably what tends you to react that way. This is some data that we pulled here that was very interesting, right? So between 1993 and 2020, if you followed the herd, right, and you sold when everyone else was selling and you bought when everyone else was buying and you're jumping in and out, you averaged a 5.5% return during that period, 27 years almost. But if you actually went against the herd and bought when people were selling and vice versa, you actually averaged over 14%, where just staying invested, the S&P averaged about 10%. So kind of argues to the fact to position yourself appropriately to your individual situation and not get too emotional and not sweat the headlines every morning,
Right. And it is hard to do. And I know that Mark, again, had mentioned too that even if we see a correction, the recovery we see may happen very quickly. So if you pull out, you may be locking in your losses.
Absolutely. And if you look at the current money market balances, they're still near historic highs in billions, trillions. It's unbelievable how much money is still on the sidelines. And so that's a very real possibility.
All right. Well, Kyle, if somebody would like you to take a closer look at their portfolio to make sure that it is properly diversified to handle and hedge against any kind of correction, what's the best way to reach you?
Best way to reach us is through the website, firstcoastfinancialgroup.com.
All right. Kyle, thank you so much.
Thank you, Erin.